The Allstate Corporation paid $4 billion to acquire National General Insurance in January 2021, $270 million for Safe Auto later that same year, and $1 billion in 2011 for Answer Financial, the comparison platform millions of Americans use to shop for alternatives to Allstate. Maryland, Florida, and Georgia regulators each reviewed Allstate's auto insurance pricing algorithm and rejected it. Their word, in each case, discriminatory. The brands you compared the last time you shopped for insurance are not competitors. They are divisions of the same corporation. The pricing mechanism running behind all of them is the same. Understanding it changes what you pay. Walk into any insurance comparison and you see a market. Allstate on one side, National General on the other. Encompass through your independent agent. Answer Financial offering to sort through all of them for free. Every one of those brands files with the same publicly traded holding company, listed on the New York Stock Exchange under the ticker ALL. The Allstate Corporation and its subsidiary National General operate under 12 licensed insurance brand names in the United States consumer market, documented in NAIC group filings. The ones Americans recognize: Allstate, National General, Safe Auto, Encompass, Answer Financial. Until March 2023, Esurance was a sixth consumer-facing label before Allstate retired it and migrated those policyholders to its other brands. Allstate's own investor materials describe the architecture in plain language. The company was designed to serve, in their words, all four consumer segments based on their interaction preferences and brand preferences. Self-directed consumers who want to compare carriers. Answer Financial. Brand-neutral consumers using independent agents. Encompass. Non-standard auto shoppers with minimum coverage needs. Safe Auto and National General. A different door for every type of customer. All four doors open into the same building. This architecture was not an accident. It was built to solve a specific business problem. When premiums on the Allstate brand climbed and a customer decided to leave, Allstate needed to own the next place they landed. When a consumer ran a search on Answer Financial to find a cheaper alternative, Allstate's comparison infrastructure was running the search. Allstate's 2023 annual report documents the result directly. While Allstate brand auto policies declined that year due to rate increases, National General auto policies grew 13.3% through independent agents. The exit route was designed by the same company that set the price that sent you looking for one. This is not a competitive marketplace. It is a vertically integrated retention system wearing 12 different logos. Insurance law in every state carries one core requirement. Premiums must reflect risk, not behavior. Two drivers with the same record, the same car, the same zip code, are supposed to pay the same rate. That is the legal standard. Actuarial soundness. In 2013, Allstate submitted a rate proposal to the Maryland Insurance Administration covering approximately 93,000 policyholders. Allstate's own internal analysis, contained in that filing, showed more than half of those customers were paying the wrong price, some overpaying by hundreds of dollars, some underpaying by comparable amounts. The expected response: correct the rates to match the risk. What Allstate proposed instead: an algorithm called complementary group rating, internally designated CGR. The CGR algorithm did not recalculate what customers should pay based on risk. It calculated what each customer was likely to tolerate before switching to a different carrier. That calculation has a name in the insurance industry. It is called a retention model. Allstate explained it to Louisiana regulators in 2015. The model estimates a customer's propensity to retain in reaction to rate changes, not their risk, their tolerance. The markup and consumer reports obtained the Maryland rate filing and ran a statistical analysis on the customer-level data inside it. That data is normally shielded entirely from public view. Their finding: the most significant factor determining a customer's proposed price increase was not their driving record. It was how much they were already paying. Customers paying more than $1,883.97 per 6-month period who were due an increase. The algorithm proposed increases of up to 20%. Customers with the identical risk profile but lower current premiums. The algorithm capped their increase at 5.02%. Same risk, same record, different price. The only variable, how much the algorithm calculated they were already willing to pay. The population most likely to receive the 20% increases was disproportionately middle-aged, male, and living in neighborhoods that were more than 75% non-white. Allstate's own data showed those customers were being overcharged. The algorithm proposed that none of them receive a meaningful reduction. Maryland Insurance Administration reviewed the proposal. Their finding: the algorithm results in rates that are unfairly discriminatory. They rejected it. Maryland was not alone. Florida reviewed Allstate's pricing proposal in 2014. Florida's rejection letter stated that setting a driver's premium based on their modeled reaction to rate changes was unfairly discriminatory. Allstate withdrew the filing before Florida could formally disapprove it. Georgia reviewed a successor version of the same algorithm, renamed TAN, Table Assignment Number Group Rating. Georgia's statement: the department does not allow the use of price optimization. Then Louisiana regulators asked Allstate directly whether any state had rejected the algorithm. Allstate's written response to Louisiana regulators, February 2015. The plan has not been disapproved in any states. Maryland had already rejected it. Allstate described that rejection as a voluntary withdrawal. The markup's review of public records identified Allstate pricing proposals using CGR or TAN in at least 39 states over the past decade. In at least 10 of those states, regulators approved the model and it went into active operation: Arizona, Arkansas, Illinois, Iowa, Michigan, Missouri, Nebraska, Oklahoma, Tennessee, Wisconsin. In those 10 states, Allstate was legally pricing auto insurance using a method that 3 other states had called discriminatory in writing. The model kept running. The retention model determines how much to raise your price. The second layer determines how much data Allstate holds about you before you ever submit a quote. In 2011, Allstate established a subsidiary called Arity. Arity's stated function: driving analytics and behavior data. On January 13, 2025, Texas Attorney General Ken Paxton filed a lawsuit against Allstate Corporation and Arity that became the first enforcement action ever filed by a state attorney general under a comprehensive data privacy law in the United States. The complaint describes what Arity built. Arity developed a software development kit, a piece of code that could be embedded inside third-party mobile apps. The kit was called the Arity Driving Engine. Arity paid app developers, in the Attorney General's words, millions of dollars to integrate the driving engine into their applications. The targeted apps were those that already required location access to avoid alerting users to a second layer of tracking. Life 360, Gas Buddy, Fuel Rewards, Rootly. Once installed, the Arity software development kit recorded a phone's precise geolocation, speed, bearing, altitude, and GPS time every 15 seconds or less. From 40 million active devices, Allstate collected what the Texas complaint calls trillions of miles of location data from more than 45 million Americans nationwide. The company's own internal description of what it built, the world's largest driving behavior database. During the period Arity was running that operation, Allstate's public privacy notice on its corporate website stated the following, quote, "We do not sell personal information for monetary value." The Texas Attorney General's complaint identifies that statement as a direct contradiction of Arity's data products business. The driving scores and behavior profiles Arity assembled were sold to other insurance companies. Those insurers used the data to evaluate risk and justify premium increases. Texas is pursuing damages of up to $7,500 per violation under the Texas Data Privacy and Security Act. Arity was also not registered with the Texas Secretary of State as a data broker required for any company processing data from more than 50,000 individuals collected through third parties. Allstate's public response to the lawsuit. Arity helps consumers get the most accurate auto insurance price after they consent in a simple and transparent way. The apps through which the data was collected did not disclose the Arity connection in their user agreements. If you have used Life 360 Gas Buddy or Fuel Rewards on an Android or iPhone in the past 5 years, Allstate may hold a driving behavior profile on you that was built before your first quote request. When consumers began actively comparing rates to escape premium increases, one platform positioned itself as the neutral arbiter. Answer Financial. It compares more than 40 insurance carriers and has insured more than 5 million vehicles and homes across all 50 states. The Allstate Corporation purchased Answer Financial in 2011 as part of the $1 billion transaction that also included Essurance. Answer Financial's comparison list includes Progressive, Liberty Mutual, Travelers, Safeco, and The Hartford. The platform does not communicate prominently to users that it is an Allstate company. Allstate's investor profile describes its purpose. Answer Financial serves self-directed, brand-neutral consumers who want a choice between insurance carriers. The choice is being administered by a carrier. Allstate is the only American insurance company that simultaneously operates as your insurer, your alternative brand, your non-standard carrier, and your comparison platform. This is not a free market with multiple options. It is a closed system with multiple entrances. If you are finding this useful, hit subscribe. Policy Exposed covers the corporate structures behind the insurance industry every week. Now for the layer that most coverage of this topic never reaches. The pricing architecture determines what you pay before a claim. What happens after you file is a separate system entirely. In 1992, Allstate engaged McKinsey & Company to redesign its claims operation. The project was called Claims Core Process Redesign. McKinsey presented the strategy through approximately 12,500 internal PowerPoint slides. Those slides became the most contested documents in modern insurance litigation history. Allstate fought to suppress them for 7 years. A Missouri judge held the company in contempt and imposed fines of $25,000 per day. Allstate let those fines accrue to $2.4 million before Florida suspended the company from writing new insurance policies in the state. On April 4, 2008, Allstate published 150,000 pages of McKinsey documents on its own website. The slides described two treatment paths for claimants, framed using Allstate's own advertising slogan: customers who accepted the initial low settlement offer, the good hands path, prompt resolution, case closed. Customers who refused, the boxing gloves path, deliberate delay, extended litigation, financial pressure. McKinsey calculated that if Allstate could reduce the number of claimants who hired attorneys by 25%, it would add $1.60 to Allstate's stock price. One McKinsey slide stated the underlying logic directly. Improving Allstate's casualty economics will have a negative economic impact on some medical providers, plaintiff attorneys, and claimants. Allstate gains, others must lose. Attorney David Berardinelli, who obtained the original litigation documents through years of court proceedings, estimated Allstate saved $15 billion through the Claims Core Process Redesign Program. In 2010, the National Association of Insurance Commissioners concluded an 18-month investigation into Allstate's use of a claims valuation program called Colossus, software that generated settlement offer ranges for bodily injury claims across 45 states. Settlement: Allstate paid $10 million. Required as part of that settlement, Allstate must notify claimants when Colossus will be applied to their case. The American Association for Justice ranked Allstate number 1 on its list of worst insurance companies in America in 2008. Allstate disputed the ranking. In 2023, Allstate raised auto premiums 16.4% for the Allstate brand and 12.8% for National General in the same calendar year. Allstate's 2023 annual report explains the rationale in direct terms: to earn an adequate return for shareholders. Net income that year, a loss of $316 million. By 2024, net income was $4.6 billion. By 2025, $10.2 billion, a 123% increase year over year, reported February 2026. The Consumer Federation of America calculated that consumers who remain loyal to one auto insurer overpay by an average of $461 annually compared to consumers who actively shop. The average American adult spends over $2,000 per year on auto insurance. $461 is 23% of that total. That overpayment is not random, and it is not the result of bad luck. It is the output of a retention model that identified you as unlikely to leave. Personal injury attorneys who litigate against insurance companies maintain private lists of carriers they will not use for their own families. Allstate consistently appears on those lists. That information exists. It has simply never been assembled for the consumer in one place. 3 questions change what you pay at renewal. The first question: what is the parent company of every carrier in your comparison? National General is Allstate. Encompass is Allstate. Answer: Financial is Allstate. A genuine comparison requires quotes from carriers outside the Allstate, Progressive, and State farm corporate families. The NAIC Consumer Information Source, available through the National Association of Insurance Commissioners website, shows the group affiliation for every licensed carrier in your state at no cost. If your last comparison included 3 Allstate family brands and 1 independent carrier, you ran 1 comparison, not 4. The second question: does your state allow price optimization in insurance rate setting? Virginia has banned it by regulation. Georgia prohibited it specifically in Allstate's case. If you live in a state without a formal prohibition, ask your insurer in writing, does my renewal premium include a retention model or price optimization factor, or is it based purely on my actuarial risk profile? The answer, or the refusal to answer, is information. The third question: did you consent to telematics data collection through an app you did not connect to your insurance? If you have used Life 360, Gas Buddy, or Fuel Rewards in the past several years, Allstate's subsidiary Arity may hold a driving behavior profile assembled from your phone's location data. California, Texas, Virginia, and Colorado all have privacy laws that give you the right to request what data a company holds on you and to request its deletion. File a data access request with Arity directly. You do not have to accept a premium built on data you never knowingly provided. The insurance industry operates on one core assumption: you do not understand your policy. The comparison sites were built by carriers. The algorithm behind your renewal price does not ask how risky you are as a driver. It asks how unlikely you are to notice a higher rate. 3 state regulators documented this in writing and called it discriminatory. Allstate spent 7 years and $2.4 million in court fines protecting the documents that described the claims strategy beneath the pricing strategy. The company posted $10.2 billion in net profit in 2025. That is not insurance failing. That is insurance working, exactly as it was designed to work. If you want to see how the same corporate consolidation structure operates inside Medicare Advantage, where 3 companies now control 60% of all enrollment, that is the next video on this channel.